So in recent sessions, we've been looking at three great topics in our syllabus. Clearly, there is the concept of control accounts and how it reconciles with individual customer and supplier accounts. So that's control accounts. The next great topic, of course, is correction of errors with or without suspense accounts. And the third great topic, of course, is bank reconciliation statements. Within that, you have to correct the cash book as well as sometimes correct the bank statement. And then you put it all through to see whether the bank reconciliation statement can indeed be reconciled. That is to say, the cash book as amended reconciles to the bank statement latest version. So those are the three great topics: control accounts, correction of errors, bank reconciliation statement. You must expect that to be examined repeatedly in your exam, several times in the 50 questions you get. All right, here we are. We come on to session number 9, as explained in the notes. This is, of course, accruals and prepayments. I suppose it's quite important for us to recap on some of the basics. So maybe I could put this down as a little marker, something to look at before we get started. A very fundamental item that I know I've put on the screen before. Assets, expenses, and losses are all, as I'm sure you'll tell me, debits, are they? Are debits. If you want to increase an asset, a debit that is, you must debit it further. If you want to reduce a debit, you must credit it, of course. That itself is like a little T account, debit credit. Matching assets on the other side, we have things like liabilities, including, of course, things like share capital, where you have companies, as we'll move on to very soon, reserves, profits, etc. The opposite of expenses, of course, is income. And the opposite of losses, of course, is profits or gains. And these are, of course, credits. And if you want to reduce a credit, you have to debit it. If you want to increase a credit, you must credit it. That's very, very important. Obviously, assets are things like balances at the bank, things like receivables, control accounts, receivables. Liabilities are things like payables, obviously an overdraft, an overdrawn balance. But now we're looking more at things like expenses and income. So we're focusing on a slightly different part of this basic rule, in particular things like expenses. So let's turn therefore to our notes and have a little read together. Very, very simple indeed. Learning outcomes for accruals and prepayments. Can I just say always examined? I suppose the fundamental rule is that you must appreciate that what goes into the income statement isn't what is paid only, but how much should have been paid, whether actually paid or going to be paid. That's known as the accruals concept of accounting. One common misunderstanding amongst newcomers to accounting, and certainly non-accountants, is the only thing that goes into the income statement is what has been paid. Or indeed, if it's income, what has been received. In other words, they assume we're doing things on a cash basis. Now that is completely and utterly wrong. It might accidentally be right, but the principle that you must approach accountancy with is that the amount received plus the amount receivable must be reported. Similarly, the amount paid plus the payable must be reported. So you must be very careful not to do accounting based on the cash basis. That is completely wrong and irresponsible, may I say. And that is really the fundamental concept here. So let's have a look at the learning outcomes. When we have completed this chapter, we should be able to explain why adjustments are necessary when preparing financial statements and compute the adjustments themselves. Why are they necessary? Quite simply, we're doing things on the accruals basis, as it's called, rather than the cash basis. Here we are, the introduction. The matching concept, might underline that word, matching, big word, states that income and expenses incurred in the period should be accounted for in that period, regardless of when invoices are raised or received. You see? So if our supplier hasn't charged us for a while, let's say a supply of electricity, something like that, we can't avoid it, we can't ignore it, we have to bring it in so that we have a realistic profit, giving a true and fair view. The fundamental rule is that income and expenditure are recognized as they are earned or incurred, not as money is received or paid. Can I just say, this is something to learn by heart. Absolutely by heart. You must know that rule. That is one of the principles on which accountancy rests. I'll go through that again. Income and expenditure are recognized as they are earned or incurred, not as money is received or paid. In order to ensure income and expenditure is recorded in the correct period, correct year, it is often necessary to adjust the financial statements. So that's the magic word, necessary to adjust. That word adjust. And so you have these accruals and prepayments. A sole trader receives his business gas bill quarterly in arrears. That simply means for the months gone by, for the 3 months gone by. In the year ended 31st December 2007, the following bills were received and paid on the dates indicated. Received and paid on the dates indicated. So we have 300, 310 and 300. When preparing the accounts for the year end, the accountant must adjust the gas ledger account to reflect that not all charges have been recorded. Not all charges have been recorded. In this case, charges for November, December need to be included. You see? Now, what else can I say? The accruals and prepayments will be the estimate of the adjustment needed. So let's bring that in. Will be the estimate of the adjustment needed. So a sole trader is a person operating just by himself, receives his business gas bill quarterly at the end of each quarter. So he's received something at on the 30th of April, and it's paid on those dates immediately, as if it's paid immediately. When preparing the accounts for the year, the accountant must adjust the gas ledger account to reflect the ledger account, of course, ends up in the trial balance, to reflect that not all charges have been recorded. So because it's taken it up to October, November and December are therefore outstanding. You see that? So from that date, I noticed that November and December haven't yet been paid. Accruals and prepayments will be the estimate of the adjustment needed. The adjustment is calculated using the most up-to-date information available. In the above example, this will be the 31st of October bill because it is at that price, especially with gas prices in different parts of the world going up and down all the time. It's useful to go for the latest as the best estimate of the future. So here it's 300. Therefore, the adjustment needed would be 2/3 of 300, on the grounds that 2/3 represents November and December of 2007, whatever this exam question did. So we're also assuming that the next quarter's bill is not yet received. Estimate. The word estimate simply means it hasn't yet been received. So perhaps I'll make that comment here. Near the word estimate, I'll do a nice big asterisk. And somewhere here, I'm going to bring in that asterisk and say, since the next quarter year, 3 months, next quarter's bill is not yet received, hasn't yet been received. So quite important to understand that. And as you can see lower down the page, there's a little journal entry, debit gas account and credit the accruals of 200. How is that so? 2/3 of 300, of course, up to the end of October, for the months of August, September, October, we felt it was 300, 100 a month. And so for November, December, it's 100 per month, so that's 200. That's how the entry is arrived at. Now, don't forget the gas account of 200 goes, of course, to the income statement. So that is charged to the income statement, whereas the accruals must go to the SFP, Statement of Financial Position, as a current liability. Okay, so very, very simple indeed. What I'd like to do, however, is to open up a gas account. So let's do this in our workings so we get familiar with the general scene. So we're talking about an expense called gas. So how to do something like this? Let's open up a nice big account. I will not let you look at the answer, if I may, because in the exam this will not be provided. So let's do the gas account. Very easy, again, very, very fundamental to real life accounting. So we have a debit and a credit. I'd imagine this is an expense because obviously you're paying it. You're not a gas company, so it's not your income as such. So it's gas account, it's an expense, and ends up as a debit in the income statement in due course. Now what has happened here is there's payment on the 30th of April 2007. So let's do our dollar signs and all that kind of thing. On the 30th of April 2007, cash for the months of February, March and April, 300. And then on the 31st of July, there's another cash payment made for May, June, July, and that's 310. And then for the 31st of October, there's cash, July, August, I suppose, August, September, October, August, September, October, there's another 300, and then comes the danger point. What do I do next, you see? I'll assume that everything is paid up to that date, in which case, as I work down the list, I find myself with a challenge, how much to accrue by the end of December. So by December 2007, I need to have an accrual carried down for November and December at the rate of 300 for 3 months. So obviously at the rate of 100 per month, it is 200. And that's for November, December, as if it's at the rate of the October bill, in case prices are changing. And so as we close off the account, it's very important to actually bring it down and carry it forward, etc. So let's leave a couple of lines. Let's leave a couple of lines. The debit side comes to 1110, 1110, and naturally that goes to the income statement as at December 07. Income statement 1110. That's a charge. The double entry, I suppose, is debit income statement, credit the gas. So the gas account disappears to 0, apart from the carry forward, of course, of 200. But the income statement itself will be debited with the 1110. And so as we conclude on this little exercise, very simple exercise indeed, we shall bring down the 200 and complete. So we're going to say on the 1st of January 08, the accrual brought down is 200. So what we're saying is, if in due course an amount is paid, let's say there's a bit of cash paid on this side in the new year, let's say in January, end of January, that first payment would be cancelled by the 200. You see? So let's say on the 31st of January 08, there's a cash paid for the months of, I suppose it'll have to be November, December, and January. If I put the figure in, let's say for the sake of argument the bill is still 300 for 3 months, would you agree that if nothing else happened, let's say the business is wound up at the end of January, what would go to the income statement on this side would be 100 to the income statement, therefore the books would balance, and that 100 would carefully have excluded, because of our the way we do it, would have excluded the 200, because 200 doesn't relate to this year, it relates to last year. You see that? So that's why, if you build that 200 into your books by bringing it down like that, whatever's paid on the other side, on this side, will be first eaten up to the extent of 200, because that 200 doesn't relate to the new year, it relates to the old year. And so by putting the 200 in as a resident on the credit side, the moment you start debiting it with 300, the first 200 is cancelled, so only 100 is left, and that goes to the income statement. Assuming, of course, you close down the business at the end of January. There's no reason why you have, but let's say for 1 second you have. It just brings out the point that the only thing that goes to the income statement is that figure relating to the new year, the 100. So that's how accruals work. Obviously, you could have a prepayment, in which case, of course, the amount that is carried forward is paid in advance. So it's called a prepayment. Let's have a look at that in a few minutes. But there you are. Now, one huge assumption I'm making as I read the question is that this business actually began on the 1st of February 2007. So maybe I'll just make that statement clear here. Assumption. Assumption is the business began on the 1st of February 07. . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . business began on the 1st of February 07. So there you are. To be absolutely honest with you, I put this in just to explain. What I might do, just remove that so there's no doubt about why I put that in. Okay, because the business began on the 1st of February, I only had the months of February, March, April, and so on in, which is why the figure covers 3 months plus 3 months plus 3 months, 9 months plus 2 months at the end, November, December, 11 months only. If you count from the 1st of February to the end of December, because January is missing, it's only 11 months. So that's how it works. Now, what I'd like very much to do is to take you on to another little exercise in this sort of area. And for that, please, would you turn to your notes? We were saying earlier, there's the opposite of accruals, of course, are prepayments. So how do we deal with these prepayments? Someone called Julie starts her business on the 1st of August 2007 and pays her business insurance, I see, for the year to 31st of July 2008. Now, if you started in August, naturally 12 months is till the end of July. Her year end is 31st of December each year, so that's her accounting year end. Of course, her insurance year end is the 31st of July, and there's some problem because those dates are different. This is the insurance year end. By contract, she's paying year by year, 12 months at a time. What charges for insurance should be stated in the income statement for the period ended 31st December 2007 is the question. Now, I'll just do explain the note as it stands. It's quite a detailed, deep kind of exercise, so perhaps it'd be easier just for me to explain and easier for you to pick up. So if the year end is the 31st December, I reckon 7 months to the end of July 2008 is prepaid. Or put another way, 5 months falls into this year. You see? 5 months. 5 months are okay out of the year you've paid. 5 months are okay. All right, so the 5 months are fine. It's just the 7 months I'm concerned with. Now, once you've paid your 1,800, the figure seems to be 1,800 divided by 12, 150 per month. So if you have 1,800 and you're dividing it by 12, it's about 150 per month. Now, because I've got a grip of the number of dollars per month, and the prepayment is 7/12, 7/12 of 1,800 equals obviously 1,050. The 750 that is left is nothing but 5 months only. 5 months at what rate per annum or per month? 150 times 5 is obviously the 750. And so that's how I managed to keep a control over it. 15,575, of course. So different ways in which you can approach it. The first most important thing is to look at the dates. The insurance year end is not the same as the financial year end, the accounting year end. So if you're paying from the 1st of August, that's when you started your business, you can't insure before you start. From the 1st of August 2007 to the 31st of July 2008, if you consider that carefully, the months of August, September, October, November, December, 5 months falls into this year, financial year. So if 5 months falls into this year, 7 months falls into next year. And because it's prepaid, at the year end you have an asset of 7 months of free insurance without having to pay anything more. Because an asset is something good, an economic resource, obviously it shows up as a current asset in your statement of financial position. Because you've paid the money, you see, and you've got the benefit. And assets are benefits, economic resources, etc. So this will show up as a current asset. And in essence, the asset is this free coverage of insurance for a few months, 7 months of the new year. So let's have a look. Assuming the insurance charge remains the same for the year ended 31st of July 2009, the ledger account would look like this. So let me see if I can move that along a little bit. The figure of 1050 prepayment obviously comes down to here, and of course that 1050 is reflected down here again. So let's move on to this lower image here. So 1800 just being repeated from before. Prepayment, of course, is 1050. It's the same as we were saying just now. This figure comes down, no problem. The income statement, of course, is 750. What happens in the new year, though? Assuming that it is still the same figure of 1800, the prepayment for the new year is 1050, and the income statement, of course, this time is 1800. The reason for that, of course, is the trading has occurred throughout the 12 months. So that 1800 is partly the old 1050 plus 750 for 2008. See that you paid this year. So that's how the figures arrived at. The prepaid amount plus the amount paid for this year in this year, and the amount that you paid in this year for next year is the new 1050 that's carried forward. So do be careful with things like that. The most important aspect, I suppose, is that we prepare accounts on the accruals basis. Accruals basis also includes prepayments basis, but you mustn't prepare it on the cash basis. That is one absolutely crucial rule, one huge confusion non-accountants have. Some people who've got exempted from F3 come up to me for F7, and they have big problems with dealing with this kind of thing because they still believe at that stage, because of exemptions through degrees and whatever, but not relevant degrees, and a quick exemption or whatever from exemption tests from ACCA. Sometimes you just get a straight exemption without doing an exam. That exemption causes a problem at F7. So can I ask you here and now to really, really understand that? We prepare accounts on the accruals or prepayment basis, but we do not prepare it on the cash basis. That is absolutely fundamental. So if I can just run through this question once more towards the end of our little session together. Clearly, if you started your business, if you're Julie, you start your business on the 1st of August 2007, that runs till the end of 2007, which is 5 months. But because you've paid for a year, there's 7 months that's prepaid to next year. So that's an asset you have. Those 7 months that you've prepaid for the next financial year starts up the new year. These year ends, financial year ends are December's. So obviously the 7 months that you paid last year gives you free cover for the first part of this year. And then, of course, when you pay the next amount, assuming that it hasn't changed, the first 7 months that you've paid last year will be the first 7 months of the current year. But the last 5 months of the current year will be covered by the new payment of insurance. So 7 plus 5, 12 months is fine. It covers your 12 months. And clearly, because you've paid 7 months in advance, you have another prepayment to carry forward. So don't forget, prepayments are current assets, accruals are current liabilities as you do your SFP. Maybe I should make that statement clear as we conclude. So let's say crucial point. accounts are prepared on the accruals and prepayments, of course, basis, not the cash basis. A common misunderstanding. Not the cash basis, i.e., what should be paid is reported whether paid or unpaid as yet by the year end, whether actually paid or not. Similarly, if you've paid too much in advance, you just have an asset at the year end because you've got free insurance cover or whatever it is. All right, so that brings us to the end of this section. Oh, by the way, all these things are adjustments to the trial balance. So maybe I'll just say these are adjustments to the trial balance, rather than the manner of depreciation, straight line reducing balance, that kind of thing, revaluations, etc. Prepared on the accruals basis, as they say. Okay, so there you are. That's IAS 1, also known as the framework, which covers the conceptual areas of accounting.